This week on Wealth Track, it's too close to call. President Obama and Governor Romney are neck and neck as they race toward Tuesday's finish line. What's at stake for the economy and markets? Answers from ISI's top Washington analyst Andy LaPerriere and Morgan Stanley's global strategist Jeff Applegate are next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. After the votes are counted, we're going to look to the future, the message of the election, what you can expect from the executive and legislative branches, and how you might want to adjust your portfolios. We have a Wealth Track exclusive with top Washington analyst Tom Gallagher. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Could it be any closer? That was the headline Wealth Track guest Andy LaPerriere sent to clients recently, and his answer was no. This one is just too close to call. The Washington policy veteran is tracking one election indicator in particular for guidance. It is the presidential approval rating in the fourth year of a first term, exactly where President Obama is now. Looking back, you can see that President Carter's approval rating had fallen dramatically, below 40% before his 1980 election loss to Ronald Reagan. At the end of President Reagan's first term, before winning re-election against Walter Mondale in 1984, his approval rating was rising and closing in on 60%. We'll contrast that to the end of President George W. Bush's first term, when his approval rating had slipped just below 50% before he ultimately beat Senator John Kerry in 2004. Now look where President Obama is. His approval rating has risen over the last few months to around 50%. It is a nail-biter. The race might be close, but for voters and investors, the stakes are significant, and the outcome will determine some winners and losers. One of the pressing issues which could face the new president is the aftermath of the fiscal cliff. The Bush tax cuts, payroll tax relief, and extended unemployment benefits are set to expire on December 31st, and a massive automatic spending cut known as the sequester is scheduled to take effect January 2nd. The president will also make important decisions on health care and defense spending, and on the possible replacement of Federal Reserve Chairman Ben Bernanke, whose term expires in January of 2014. Well, joining us to discuss these election issues are two policy and investment pros. Andy LaPerriere is Senior Managing Director of top-ranked independent research firm ISI and heads up its policy research team in Washington, D.C. LaPerriere has been a coveted Institutional Investor magazine-ranked Washington team analyst for the past 14 years, and the team has been ranked number one for the past 10 years. Jeff Applegate is the Chief Investment Officer of Morgan Stanley Wealth Management and is responsible for strategic and tactical asset allocation advice to clients. He leads the firm's investment strategy team and chairs its global investment committee. I began the interview by asking LaPerriere why he thinks the race is as close as it is.
Well, I think the race is close because you have a vulnerable incumbent. I mean, you've got a president with a job approval that's been below 50% most of the last 2.5 years. You've got a weak economy. The legislative agenda that passed in the last couple of years is not popular with the public. So you have an incumbent who's going into re-election in a weak position, a lot like you had in 2004 with former President Bush. And you have a reasonably strong challenger in Mitt Romney, someone who's ideologically mainstream and was running a poor campaign until the Denver debate, but has turned it around since then. So I think you've got the makings, and I think we've always had the makings of a pretty close race here.
Jeff, you have a global clientele,
right.
And you talk to international clients all the time. So what's the view from your international clients of this race and how close it is and what they're thinking about the significance of this election?
Yeah, I think broadly there's somewhat higher comfort level with Obama, which has nothing to do with his policies. It's just they think they know him. Whether they know him or not, they think they do, because he's had a first term. Versus Romney is more of an unknown quantity. So it's not really clear in terms of foreign policy and those kind of issues, and where is he going to be on trade? Is he going to be supportive of trying to move WTO forward? Those are sort of open issues, I think, with non-U.S. investors.
Okay. Andy, you think, you've been a Washington analyst for a couple of decades, and at least, and you think that there is actually a lot at stake for investors in this election. What are the major issues that investors should pay attention to, that whomever wins the election, it's going to make a difference?
Well, I think a lot of big decisions have to be made on fiscal policy, and I think those are going to matter to the markets, those decisions. And obviously, we're facing the fiscal cliff at the end of the year here, and as you get into next year, where all three of the major rating agencies have suggested we're going to downgrade the U.S. debt. So this budget issue,
if what happens,
if there's not a significant long-term deficit reduction package, basically all three of the rating agencies want to see Congress stabilize debt to GDP, and if not, all three of them have suggested that they would downgrade the U.S. So we're coming into a pretty critical period here, where we both have short-term problems in terms of a fiscal cliff, and it's time now, I think, to address the long-term budget problems, or we're going to see some ramifications of not doing that.
Right. And Jeff, as far as you're concerned, again, from an investment point of view and a market point of view, you don't think this is such a big deal, right?
Well, I think the fiscal cliff, first, some aspects of the fiscal cliff have already been dealt with.
Yep.
So Congress has now approved funding the government into next year. The debt limit won't be breached by year end. It'll be breached some point in the first quarter. It's not to say you don't have to deal with those things, but they're not all coming together at year end. So in fact, what you'll get at year end, most likely, and I don't know if Andy would agree with this, but you'll get expiration of the payroll tax relief and expiration of the extended jobless benefits. There doesn't seem to be political support to extend those.
Right.
So we think there's going to be some fiscal drag, but not enormous fiscal drag. And if that's the outlook, then that should be positive for the markets. But I think the really key thing is really looking into next year, and can we pull together a credible deficit reduction package? Because if we don't, to Andy's point, the credit rating agencies are waiting in the wings. And the last time they got involved in this, just go back 2 Augusts ago, that was not exactly a picnic for the financial markets.
Right.
So it's going to be crucial to get that right.
So let me ask you about that, the fiscal cliff. So regardless of what happens on Tuesday at the election, is that we've got this 12/31/2012 deadline for the fiscal cliff. We know when the Bush tax cuts expired, and we've got Obamacare, Medicare taxes going up, and we've got the two things that you think will be resolved before then. But so what is your outlook for the fiscal cliff? How is that going to be handled? How is it going to be resolved, Andy?
Well, I think what Jeff said is the base case, but that requires a deal in the lame duck. It requires a deal to extend the Bush tax cuts. It requires a deal to delay the sequester, to deal with the AMT, doc fix, and a few other miscellaneous issues. So if they don't get a package...
And that's Obama with the lame duck Congress.
Right.
Before year end.
So what Jeff outlined is the base case, and I think he's right, the payroll tax cut's going to expire, and if there's a deal, there'll be a modest fiscal tightening. I do think that the odds of two different outcomes, one which would be real negative for the market and one which would be positive, are higher than the investor consensus. I think there's a decent chance that, say 1 in 3, maybe even a little higher, that there's no deal in the lame duck. The Bush tax cuts expire completely, the sequester kicks in, and so that would be a real negative outcome, obviously, for the market. There's also a possibility of an upside surprise. I think this is pretty unlikely, maybe 1 in 5, but I think it's higher than maybe the investor consensus, that they could reach the outlines of a deal on the grand bargain, the handshake between Boehner and Obama, assuming Obama's reelected president under that scenario. And if that happens, that would be very bullish for the market.
So what happens if Romney gets elected? So what does the president and the lame duck Congress do in that case?
My guess would be that they would relatively easily be able to agree on delaying the sequester, dealing with AMT and a few other miscellaneous items in the fiscal
alternative minimum tax.
The alternative minimum tax, right.
And forgive me for stopping you there, but dealing with that means what?
Well, under current law, there's an exemption that gets indexed to inflation that wouldn't be indexed to inflation, so there'd be a big tax increase on people, and they would have to pay the AMT, the alternative minimum tax, about 20 million households that now don't pay it.
Right.
And so that would be a big surprise tax increase that people would actually find out during their tax filing season. So I think it's very, very likely that's going to get dealt with no matter who wins the election. What the difficult part would be is if Romney wins, Republicans will insist on a full extension of the Bush tax cuts. And the question is, well, will Obama sign even a one-year full extension of the Bush tax cuts if he loses the election? And I think that's a tough call. So if he doesn't, then the Republicans would probably try to deal with it relatively quickly. With some support on the Democratic side in the Senate, they could probably pull that off.
So, Jeff, the fiscal cliff,
right.
You are confident that the fiscal cliff will be resolved, that the sequester will not take effect,
right.
Where we have these massive automatic cuts in spending in the government. Why are you confident that that's going to occur?
I think at the end of the day, most incumbent politicians would agree that it doesn't make sense to let action occur which threatens to tip the economy into recession and throw their constituents out of work. So it's really a very sort of simple political calculus on my part, and I think that will be shared on both sides of the aisle. So you'll be able to get an agreement. And I think you can get an agreement whether it's President-elect Romney or whether it's a second term for Mr. Obama. I think you get it under either scenario.
And what if you're wrong? What does that do to the market? What if everybody kind of digs in their heels and just
right.
says, we're not going there?
If we get gridlock,
right.
which is certainly above a zero possibility, right?
We've had it before. Yep.
That's right. Then I think the market sells off, potentially severely, and then we'll see what the political response is to that, because obviously politicians do pay attention to what's going on Wall Street. But it may mean that it just gets pushed off until January, and again, an Obama second term or a Romney first term, and a new Congress where the composition is arguably going to be different.
So let's talk about that, because you sent recently a report out to your clients at ISI saying that the worst case scenario is a Romney win in a Democratic Senate. Why is that such a bad outcome?
Right. Well, it's a little bit complicated, but I think that basically, if you look at all the other scenarios, Republicans and Democrats don't have to compromise on the Affordable Care Act, the president's health care law. They can just agree to disagree. And if it's a Romney with a Republican government, they're going to repeal a lot of it, and they're not going to get Democratic votes. They don't need Democratic votes. If it's an Obama scenario with a Republican House, the president's reelected, he's obviously not going to sign anything that's going to undo his health care law, so the Republicans are just going to have to adjust themselves to that. Well, if Romney wins, Republicans are going to insist on big changes to the health care law, but now they don't have the votes to do that in the Senate. So who's going to give? Who's going to give on that? And I think the answer is neither is going to give initially, and they're going to duke it out, and they're going to see who's winning with the public on that. So that's a scenario where I think you could have an extended period of where both parties are just going at it over the Affordable Care Act.
So we've been there before, Jeff, and here you're the Chief Investment Officer of Global Strategy at Morgan Stanley Wealth Management. So you've got to deal with kind of the reality that is, and the probabilities that are.
Right.
So talk to us about your strategy. Number one, does the outcome of the election, how much will it affect your strategy, if at all, depending on who wins the election?
Yeah, I don't think it affects it on the margin, but I don't think it affects the core strategy. I mean, we've got a view that risk assets are the place to be.
And that's stocks, primarily. And that's emerging markets.
Equities, emerging markets, but it's also credit within fixed income, investment grade,
so
high
corporate
yield.
Bonds, right?
Exactly.
Investment grade.
Economically sensitive sectors of the bond market. So it is a view that, the economy will continue to grow, earnings will continue to go, global growth will be probably on the order of 2.5%, 3%, even though Europe is in
And that's
recession.
real growth, that's not including inflation.
That's real growth.
That sounds very low to me. I mean, global growth.
Well, keep in mind, Europe is a big economy.
Yes, and it's in a recession. Right.
And U.S. growth is no better than 2%. And emerging markets are not immune to all this. So they're not growing at 7-8% anymore. They're growing at 5.5%.
Right.
So you put all that together, what falls out of that, we think, is about 3% global growth, and then earnings growth probably on the order, roughly double that, about 6%.
But that tells me that that's not really a great environment for business and for stocks. So why is that? Why are you saying you can be, more aggressive with your portfolios? Because and that's a change from Morgan Stanley when you were kind of risk off until August.
Right.
So what's giving you encouragement that stocks and corporate credits are going to do well, and you don't want to kind of batten down the hatches?
Well, it's really been, what we haven't talked about yet is monetary policy. So it's been what the ECB has committed to do, and Mario Draghi going back to the summer saying, basically we'll do what it needs to take.
Right, what it
and
takes.
it will be enough. So Europe is bit by bit, working through that in the appropriate way, we think. And then you had the Fed embrace QE3, which we thought they would do, but what we didn't know they'd do is that it would be open-ended.
Right.
So the Fed is basically going to has said, we're going to be very accommodative for the markets for an extended period. That's generally overwhelmingly pretty good for risk assets.
And let's talk about that because, Andy, I know you have written an editorial, an op-ed editorial in the Wall Street Journal earlier this year, and you've been quite critical of this open-ended, purchases of mortgage-backed securities and Treasury securities by the Fed. So why do you think that is a dangerous course of action to take, and what impact do you think that's going to have on the markets as well, this Fed policy, expansive policy?
Right. Well, I wouldn't disagree with Jeff that this has been positive for the markets in the short term.
Because it has been very positive for the markets.
It has been. But what I would argue is, basically what the Fed is doing is it's trying to encourage people to spend their wealth and increase asset prices and to encourage people to consume more than they otherwise would. And every economist, including Bernanke and others over time that have testified before Congress for the last 25 years have said we need to save and invest more. And what we have is a policy that's designed to discourage saving and investment. And so we're sacrificing long-term economic growth for short-term positives, which I think are very minuscule. And for the average person who doesn't have that much in the stock market, they're paying higher food and energy prices, and they're hurt from a weaker dollar, and they're not really benefiting from higher asset prices. And in the long run, I think this is detrimental to long-term economic growth. And so I think the risk-reward and the cost-benefit analysis are, I think, for the average person and for the long run of the country, argues against what the Fed is doing.
Of course, this is an election issue because Governor Romney has come out and has been very critical of Chairman Bernanke and the Fed policy, especially the QE3.
Actually, more so during the primaries than
he is
during
now.
The general election. Yeah.
However, my understanding is that Governor Romney has said, I would replace Fed Chairman Bernanke, but of course his Fed Chairman Bernanke's term is going to end at the end of next year.
Right.
So does that figure in this election, the impact that this election could have as far as who's going to lead the Fed?
Yeah, not on a near-term basis.
Right.
Plus, keep in mind, obviously the chairman of the Fed is a hugely powerful position.
Right.
But monetary policy decision-making isn't simply one person, one vote. It is the FOMC. And the FOMC appears to have a fairly strong consensus that what they've done with quantitative ease in the latest version, people are on board with that. So
right, with one dissent, I guess, recently.
Yeah, exactly. But so just changing the chairman isn't then going to change the basic thinking of the FOMC overnight. That will take quite some time because there is such a strong consensus that what the Fed is doing is appropriate for the economy.
So, Andy, do you feel that way too, that really is not a pressing issue as far as Governor Romney would
right.
replace?
Right. Yeah, Jeff and I don't agree on the merits of what the Fed's doing, but I think we do agree on the outlook for the Fed. I think Bernanke's not going to be asked to step aside. Romney's not going to do that. He's going to serve out his term, and he is only one member, and so it will take time for the composition of the board to change. And so you're talking about monetary policy being impacted slowly and over a long period of time if Governor Romney is elected president.
Winners and losers with this election outcome. Jeff, you said it would make a difference on the margin. So are there margins that we should be paying attention to? I mean, are there some clear winners and losers that you would actually change, adapt your portfolio on the margin to?
We would. And if we got a good outcome and then you had people talking about, yes, we're going to take appropriate action on the fiscal cliff and long-term deficit reduction activity into next year, then I think that would be better for risk asset markets, and that would prompt us to revisit a debate we've had, which is, should we actually increase the beta in our portfolios?
And where would you increase your exposure to risk assets, particularly? Which sectors would really benefit?
Well, we really do it not so much by sector, but by geography. So it would really probably go more to the U.S. Because the last move we made was really to put money in the European equities.
Right.
So it'd be more U.S., but also by extension probably emerging market equities, because if growth is going to pick up here in the U.S., this is obviously a pretty important market for the global economy and for emerging markets. So those would probably be the two primary places.
Okay.
And we'd probably also increase our credit exposure.
Right. And so those are equities you're talking about, U.S. stocks. And I know you're favoring large cap growth stocks.
Right.
Right. and emerging market stocks.
Correct.
All
That's
right.
right.
Winners and losers, you've drawn up clear lists at ISI depending on which candidate wins. So who are the winners, who are the losers for each candidate?
Well, I think the big sectors you want to look at are healthcare, defense, and energy. I think the healthcare names are especially sensitive to this whole budget debate. If Republicans do well, I think what they'll do is they'll leave in place a lot of the offsets in the healthcare law, but take away the benefits.
So meaning, what do you mean by that?
Meaning, hospitals, for example, they were going to benefit from more people having health insurance coverage
Under Obamacare.
Under Obamacare, but what they paid for that was lower reimbursement rates. I think Romney might leave in the lower reimbursement rates, but get rid of much or most of the benefit coverage, and so that means
hospitals would lose under Romney.
They lose under Romney, gain under Obama, and you've seen those stocks have been the most sensitive to the swings we've seen in electoral fortunes here over the last several weeks. Medicaid HMOs is another example of that. They pay the tax in the president's health care law, but they get 15 million more people covered under Medicaid. Well, they may keep the tax, Romney may keep the tax, but they're not going to get the 15 million additional lives covered under Medicaid.
So HMOs would lose as well under
Medicaid
Romney.
HMOs, although overall HMOs have been winners under Romney, or seen as winners by investors under Romney, because Republicans believe in a greater role for the HMOs in the Medicare system, whereas Democrats would have a more reduced role for HMOs. Energy, this is more of a regulatory change. I think very little legislation is going to get through, but I think there'll be a sense that under Romney it'll be full speed ahead with all of the above, whereas under Obama the EPA could be a lot tougher on traditional sources of energy, oil, coal, natural gas in the second term.
And was there a third sector?
Defense.
Defense.
Yeah,
oh,
defense.
duh.
Yeah,
So
so defense, Romney's talking about increasing defense spending, or at least not cutting it anymore. I think it's going to be tough to actually increase defense spending. I think they'll actually live with these budget caps, but if Obama wins and there's some kind of grand bargain, which I think there is going to be a grand bargain if Obama wins, then the caps will come down for defense and defense will get cut more.
If there's one investment, Jeff, that we should all make in a long-term diversified portfolio, what would it be? What would your advice be for our long-term investors?
It really hasn't changed. It would still be emerging market equities to us. And we've been talking a lot about policy here. If you look at the policy mix in most emerging markets, it's, for the most part, hugely superior to the policy mix, both fiscal and monetary, in most big developed markets. And you also have these economies where they're at a just different point in their life cycle. So their potential GDP isn't 1 or 2 or 3% in terms of potential growth. It's more like 5 or 6%. So much better fundamentals and a much better policy mix. Now, emerging market equities have actually underperformed U.S. equities, not by a lot, about 1.5% so
and price
far
matters,
this
so maybe this is a good time.
Yeah, I mean, certainly the valuation is not daunting. If you look at emerging market equities, they're actually pretty much in par with developed market, with a better set of fundamentals and policy options.
And I know you're not going to recommend a fund, but Morningstar has an ETF that they recommend that Vanguard puts out of an emerging markets fund.
Which is passive and obviously low fee, and it's a good way,
right,
good vehicle to use to play emerging markets, yes.
So Andy, you can go anywhere you want with this question. What's the one investment that you think that we should all have in a diversified portfolio?
So a long-term investment, I think you need some protection against the risks of higher inflation. I think given the budget situation that we have, even though I'm relatively optimistic Congress will deal with it appropriately over time, that's a real risk, coupled with a very easy monetary policy. I think you need to have some protection against long-term inflation, not near-term, but in the long term.
Okay, so we're talking about real estate, we're talking about gold potentially.
Some hard assets that provide some inflation protection, absolutely.
Right, and I'm going to ask each of you, so who do you think is going to win the election on Tuesday? Jeff? And it can be personal, you don't have to put Morgan Stanley on the line.
I think the incumbent's going to win.
Okay.
I think
Andy?
I think it's been close. It will be close, but I think given Romney's slight lead in the polls that we've had since the Denver debates, I think you give him the edge.
All right, and so then that's why we have a
We'll
difference of opinion.
Tuesday.
We'll
Right.
find out on Tuesday. Right. Thank you both so much for joining us. So Jeff
Thank
Applegate, always a treat to have you, Chief Investment Officer of Morgan Stanley Wealth Management.
Thank you.
And Andy LePerriere from ISI Group, the head of their top-ranked Washington team. Thanks so much for being with us. At the conclusion of every Wealth Track, we give you one suggestion to help you build and protect your wealth over the long term. This week's action point is vote. This promises to be an extremely close election. The margin of victory can be razor thin. The closest election in recent memory was between John Kennedy and Richard Nixon in 1960. JFK won by a mere 36,000 votes in that one. President George W. Bush won the key state of Florida by just 500 votes over Vice President Al Gore in 2000 after the controversial recount. As we just discussed, there is much at stake for investors in this election, and your vote can really make a difference. Well, next week, after the votes are counted, we're going to look to the future, the message of the election, what you can expect from the executive and legislative branches, and how you might want to adjust your portfolios. We have a WealthTrack exclusive with top Washington analyst Tom Gallagher, who now hangs his hat at the Scowcroft Group, but for many years headed up Andy LaPerriere's team at ISI. Until then, if you would like to watch this program again, please go to our website, wealthtrack.com, where you can also find additional interviews with WealthTrack guests in our new and improved WealthTrack Extra feature. And that concludes this edition of WealthTrack. Thank you for watching, and make the election week ahead a profitable and a productive one. Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.